Hey everyone, welcome back to the channel. I'm Zach Palmer, and today we're diving into a real example to show how much tax savings you might see this year from the new tax bill, the big beautiful bill, if you're someone who itemizes deductions on your tax return. We're coming to you with a slightly different format here. So you can see I got the Loom video up. We're going to be sharing screen to kind of look through our tax planning software we use with clients. So, in case you missed it, a new tax bill was passed earlier this month that has shaken up the tax code. So today we'll look at a case study comparing the old tax code under the Tax Cuts and Jobs Act and the new tax code under the big beautiful bill. In front of us here, we got a sample scenario with Ryan and Emily. Disregard scenario 1. We're going to be focusing on column scenario 2 and column scenario 3. So let's jump into Ryan and Emily's tax projection. We'll start, so their collective W-2 income is $450,000. You can see those are mirrored in scenario 2 and 3, and as well as the income, investment income, we have dividends and interest accumulating to $10,000 in each of those scenarios. So, the income component here, let's see, let me scroll down here, does not change from scenario 2 to scenario 3. Or we will see a change is the itemized deduction section, which we will scroll down to now. So Schedule A, itemized deductions, this is where the big change occurred from the former tax code to the current tax code. And you guys may be familiar with the SALT cap deduction. SALT stands for state and local taxes. Under the Tax Cuts and Jobs Act, again, the former tax code, the SALT cap ceiling was set at $10,000. But under the big beautiful bill, the cap has been raised to $40,000 for individuals and households with $500,000 or less of income. So let's break down the three components of SALT tax for Ryan and Emily's situation. First, we got state and local income or sales tax, which relates to state tax withholding from income throughout the year. So if you're a W-2 employee, this is the annual amount that is withheld from your paycheck to state taxes. So for Ryan and Emily's case, we're assuming they had $20,000 withheld because they live in a relatively high income tax state. So this might be common for states like New York, New Jersey, Connecticut, and California, just to name a few. The next component of the SALT cap, or of the SALT tax, rather, is state and local real estate tax, which relates to the property tax on their home. So this would be this line item is only for homeowners, and in Ryan and Emily's case, their 2025 property tax bill is $9,000. And so the last component of the SALT tax is for state and local personal property, which is for cars and boats. So for this illustration, Ryan and Emily have newer cars in which their 2025 property tax collectively equates to $4,000. So in total, you can see the total SALT tax amount for the year, $33,000. And where we start to see a difference is the deductible amount of state and local tax here in scenario 2. Again, that's the cap of $10,000. But under scenario 3, the new tax code, they are able to deduct the full $33,000. So you go from having a wasted deduction of $23,000 to a full applied deduction here with the new tax code. All right. So the state and local tax, the SALT tax, is just one of the commonly used itemized deductions. There are also other components that make up itemized deductions. We have medical expenses. We've left that blank. We have charitable contributions. We've left that blank. But what we did apply is mortgage interest. So that can be deducted on the itemized portion of your tax return. And that amount here is $25,000. So let's just kind of a quick sidebar, and this is more of a mortgage calculation exercise. Let's look at two possible mortgage schedules they could have, hypothetically, to get them to that $25,000 of mortgage interest. So starting with kind of one option here is they have a higher home price, $975,000 home, that they bought in 2022 at 15% down and took a loan of $820,000 at a very competitive interest rate, 3.25% at the time. Now we know that interest rate is long gone, but so you can see in year 4 of their loan, they have $25,000 of interest, mortgage interest. Comparatively, let's say they bought at the beginning of last year. Obviously, interest rates were at a totally different level, but so let's say they bought a $525,000 house, put 20% down, and had a mortgage of $418,000 with a 6.75% interest rate. You can see, yes, in year 2, they are actually also paying $25,000 in mortgage interest. So just goes to show, mortgage interest can look vastly different depending on your mortgage terms. Anyway, back to the projection here. Okay, yeah. Total itemized deductions, comparing old tax code to new tax code. We have $35,000 because you have the $10,000 cap under the old tax code plus the $25,000 of mortgage interest, you get to $35,000. And then the current tax code under the big beautiful bill, we have the full $33,000 from the SALT tax plus the $25,000 from mortgage interest, which gets you $58,000. So yes, you're seeing the full difference, and that is also reflected in taxable income. A quick reminder that itemized deductions don't reduce your income dollar for dollar, they reduce AGI. That's why you're seeing the difference reflected here in taxable income. All right, now for the big reveal. So how much do they save in taxes? Well, here's your answer. The total tax under the old tax code owed at the federal level is $91,800 versus under the new tax code, $84,440. So that's $7,400 in tax savings for Ryan and Emily under the new tax law. Pretty sweet, right? That's a new vacation, or if you think of it like me, more than the amount needed to make one of their backdoor Roth contributions. Either way, that's money back in their pockets, which is great. So every year, we go through tax projections like this with our clients to give them an idea on where their tax situation will fall and to look at tax planning opportunities. So that wraps up the exercise here to kind of dive into the numbers behind the tax change. So I hope this video was helpful. Be sure to like and subscribe. And if you want to see a different example within our tax planning software, drop it in the comments below. Thanks for watching, and I'll see you next time. Cheers.